Hello, friends. Good day. Hopefully, all of you are doing good and are doing good with your studies as well. I'm here with another video on audit and assurance. I have started a series of videos on my YouTube channel regarding audit and assurance, especially for professional accountancy students. So, today we are gonna learn one more concept, although we have learned about that in our previous videos. In my previous videos, we learned about audit limitations, and before that we also learned about what is an audit and all that. So there is one more attached concept related to that audit limitations. So let's move forward and review that. What is that basically? So the new concept, or you can say the attached concept with that limitations on audit, is expectation gap. like you know auditors normally what they do, they provide opinion over the financial statements of a company. So there must be expectation as well from their stakeholders. So if we talk about the expectation gap, so due to this is also a limitation, this is also a limitation, right? So this is expectation gap means people think, or the user of the financial statement think that if financial statements are being audited by the external auditors, that means the financial statements are 100% free from any bias, fraud, errors and all that. So that is not the case. If auditor is examining or auditing the financial statements, that doesn't mean that financial statements are 100% free from errors, fraud and all other things. So if we read this statement, some users incorrectly believe that an audit provides absolute assurance. like we discussed in my like I discussed in my previous videos, uh, that external auditor does not provide absolute assurance. They only provide reasonable assurance to the users of the financial statement. That the audit opinion is a guarantee the financial statements are correct. That doesn't mean this is not the case that financial statements are 100% correct and there would be no errors, and that would be free from fraud and all that. That is not the case. This and other misconception about the role of an auditor are referred to as an expectation gap, and that is your expectation gap, because users of the financial statements create expectation with the auditor that they are 100 they are telling them that financial statements are basically 110% correct, and that is completely not the case. Okay. Hopefully you have understood this concept now. uh, Examiner might ask you what is an expectation gap, so that means you have to write about the limitations of an audit. Now moving forward, examples of expectation. Examples of expectation is like a belief that auditors test all transaction balances. They test on a sample basis. You know that auditor only perform testing on a sample basis. Not they can't because of the time limitation as well, because the other things as well, because of the inherent limitations as well. Auditor can only provide reasonable assurance by applying sampling technique, which we will discuss later in our more videos about audit and assurance. So audit does not test all the transactions. They only test few samples, and on that basis they provide their opinion. Next one is, I believe that auditors are required to detect all fraud. Auditors are required to provide reasonable assurance that the financial statements are free from material misstatement which may be caused by fraud. You know, uh, yes, auditor can provide or detect fraud during the course of an audit, but this is not the responsibility of an external auditor to detect fraud. But yeah, if in the course of an external audit, if an auditor identifies that there is a possibility of fraud, they may identify and indicate management about that fraud. Because there is a separate assignment as well in the field of, you can say, public practice or auditing, there is the name of the forensic audits. Basically in that, in those audits, auditor are basically going to detect those frauds and going to identify frauds. But here we are talking about external audit. So here external auditor's responsibility is not to detect fraud. Okay, so the external auditor would be providing only the opinion over the financial statements of the company, or they provide reasonable assurance that the financial statements are free from material statement which may be caused by fraud or maybe error as well, right? Hopefully you have understood this concept. So in summarized version, you can say that expectation gap. Next one is, I believe that auditor responsible for preparing the financial statement. This is one of the another expectation gap between the user of the financial statement and auditor, because the primary responsibility of preparing the financial statement is with the management, not the external auditors. Yes, when I was doing audit in Deloitte and PwC, yeah, we used to prepare financial statement during the course of the audit as an auditor. But in most of the countries auditor do. But if you talk about the rules and the regulations, the primary responsibility of preparing the financial statements are with the management, not the external auditors. External auditor provide, you can say, if we talk about the practical example, what external auditor do normally, they prepare financial statements and and compare them with the financial statement of those management have prepared. So that comparison, because management might have made some incorrect financial statements, and so what auditor do, they compare with the financial statement that management have prepared in order to identify any issues or errors or whatever you say. So that is another expectation gap that user of financial statement expect from the auditor. Moving forward, limitations of an audit. Although I have made a video over limitations of an audit, my previous videos, but we are covering again because the expectation gap is linked with limitation of an audit. So that is why we are discussing again here. The financial statements include subjective estimates and other judgmental matters, right? There are lots of provisions, judgmental matters, estimates. Like if we talk about depreciation, that is also an estimate. If we talk about bad debts, that is also an estimate. Otherwise, there are other provisions as well that we have to use during the preparation of the financial statements. So that is an limitation of an audit. Next one is internal controls may be relied on, which have their own inherent limitations. Like in government sectors, normally controls are weak as compared to the private sector, if I talk about general. So there may be high risk and we have to perform more substantive procedures in case of public sector, but we might have to perform less substantive procedure uh, in case of private sector because of the uh, im- improved control environment, right? So internal control may be relied upon. In some cases, we have to rely on internal controls due to the limitation of the time and all those things. So internal control is also an inherent limitation because we can't 100% rely that internal controls are. So we have to just assume that internal controls are good at the entity. Next one is representations from management may have to be relied upon as the only source of evidence in some areas. Like in some cases, if there are some limitations, or you can say there are hurdles that uh, which are unable to uh, uh, remove. So in that case, we might have to rely upon management representations, or what management is asserting. We have to rely upon that. So management representation is again a separate topic and separate ISA, internal standard, international standards on auditing. So that is a separate ISA. So we will discuss later what is basically management representation and what are management representations. But here, this is one of the limitation of an audit. Next one is evidence is often persuasive, not conclusive. What is mean by that? Management may hide their expenses through fake invoices. Like during my experience, my practical experience, during my experience in external audit firms, I have seen some cases where management was preparing bank confirmations and making invoices just to hide their expenses and just to hide their numbers. So in that case, you can say evidence is often persuasive, not conclusive, and we, as an external auditor, have to rely on evidences, whatever we get from the management, right? So you can say evidence is often persuasive, not conclusive. And last, do not test all transaction balances. Audit test on a sample basis. We have already discussed, because auditor do testing on a sample on sampling basis, not they cover all the numbers in the trial balance, you can say. So this was my video about the expectation gap. Hope you understood all the concepts. If you have any queries, do comment below my video, and you can I will share my phone number as well. If you want to ask any other question, you can text me on my WhatsApp number. Other than that, do share my videos. If anyone is in need to understand these concepts, you can share with them, and like, share, and subscribe. Thank you so much. I will be there with another video about audit assurance and IFRSs. If you like it, do comment below. Thank you so much.